Hello everyone, welcome to our weekly market analysis session for Monday 8th of August. My name is Carl Capolingua, I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be joining you for our wrap of the week that was and a look ahead to the week that will be. Let's kick off with crypto markets, and I do these snapshots on a Saturday to Saturday basis. So let's call it the unofficial end of the crypto trading week. Of course, crypto continues to trade Sunday and Monday morning our time as it is. Now, a lot of these have changed to the good, so don't panic. Avalanche up about another 7 or 8%. Bitcoin's up about 2% there, probably flattening out that loss from last week. Cardano's up about 4%. Something like Polkadot up about 4% as well. Solana up about 3.5% from those lows. And I'm also thinking about something like Atom, which is up about 8%, looking very, very strong at the moment. And Near Protocol up about 4.5%, looking very good. Go check out the charts on those. So some of this is a little bit outdated by recent market movements. The Fear and Greed Index at 30, still pretty low, lower than it was yesterday and last week, but no doubt going to print significantly better tomorrow. Having a look at the Bitcoin chart, and imagine it up a little bit more from that close there. It's pretty flat anyway, let's face it, and this range continues to dominate. This 25,366 to the upside, this 2709 to the downside. Let's round them off and say 25 handle to the upside, 20 handle to the downside, to get that FOMO back into the market, because let's face it, there aren't a lot of sort of fundamental drivers for Bitcoin at the moment. Not a lot of news flow out there apart from the wonderful and hilarious memes that are popping up on Twitter again about Bitcoin rising from the ashes. A close above 25,366. I'm going to start to feel a bit more FOMO coming into the market, and then we can probably move into the high 20s, so 27,878, the next level there. But really, the dominance of that long-term downtrend zone kicking in around about that 28, 29 level, and all the way up into the low 30s there is going to be a problem going forward. Hey, that's all looking up sort of stuff. If we look down, a close beneath 2709 will see us come back and test those lows around 17,585. So happy to maintain that short-term uptrend bias. You can just see the little light green zone just starting to eke itself out there. But as you can see, it's hard to get really excited about Bitcoin at the moment. It's easier to get more excited about Ethereum. We do have a narrative. So we've got the merge coming up September. Hopefully, these things never go to plan. Hey, if it gets kicked down the road, if anything, it extends this positive narrative, and it's causing an outperformance of Ethereum. We can see the short-term uptrend far stronger here, far well established. It's steeper, it's expanding. That's great. We can see a bunch of nice white candles coming in. So you can see these two very strong white candles here, very shallow pullback, and not challenging too much of that range, that initial demand pulse range, and then the nice white candle coming in. We assume we're moving back up, obviously with today's little bump. So I call this a control pattern, a demand side control pattern, where you get that strong move up, the shallow retracement, and then the strong move again. But we are going to bang up against that long-term downtrend zone. It's going to come in just beneath that key 2000 handle. That 2116 probably going to also come into play in terms of the supply side. You can see where I've drawn that red arrow. But I do think we're going to get there as the market continues to focus on this narrative, and of course this idea that as investors are stacking their ether, they need that 32 ether to participate in the validator rewards for this move to proof of stake, away from proof of work, that is going to remove supply from the market and facilitate potential price rises, not just in the short term, but in the medium and long term as well. To the downside, I don't want to see it close below 1559. It would start to change this bullish narrative, and certainly not a close below 1356. I think it's lights out from there, and we'd come down and test 880. Bringing it back to equities now, looking around the various geographic regions, we can see Asia, pretty much a mixed bag. Shanghai down about 1%, but the other two modest gains. Modest gains there on the S&P 500, the benchmark US index, but another strong gain from the NASDAQ, up 2%. Incidentally, NASDAQ now up more than 20% from its low, and therefore in that official bull market using that metric. I'll talk a little bit more about that in a second. The Dow Jones down 0.1%. Europe doing pretty well. We can see volatility on screen. It's 1, 2, 3, 4, 5, 6, 7, 7 weeks down in a row now. Extraordinary, considering that 7 weeks ago, markets were absolutely tanking and it looked like the end of the world. And you can see that reflected here, this amazing, stunning turnaround, not quite a V-shaped, a little bit of trepidation there, 37.38, 37.21, 39.46 to the upside, but it has been a very solid rally, punctuated by a dominance of these white candles. And don't forget, those white candles are all about buy the dip intra-session. So it's investors with cash looking to take advantage of any pullback. That's how you get those white candles. And then the peaks and troughs. So higher troughs, well, now we've got buy the dip on a broader basis. And obviously when you're making those higher peaks as well, you just continue to remove supply. Certainly supply is not able to have any impact on the price action. So looks pretty solid there, can't fault it. Lots of white candles, high peaks, high troughs, good price action in terms of where those peaks and troughs are coming in relative to each other. However, and there tends to be the however in this case, that 41.78, you can see we're there. I mean, we're back up here. It's the long-term downtrend zone as well. It will, I think, resist prices, if only for a week or two, before all of those positive things I talked about can get us above that. But close above 4,200, that's the first step. A test, a hold, some time here, some consolidation of these gains would, I think, be welcome to set us up to provide this healthy base for a push higher, potentially even to 45.13. That's the best case scenario. The worst case scenario is something bad happens in the world, or a combination of factors to cause a bunch of black candles in and around this zone. This is what you need to watch out for now between, me speaking right now and our next update on Monday next week. If you get a string of black candles in here, it's telling us that supply is finally starting to have an impact, put its fingerprints on this chart, and we then could come down into 4,012, but there is a strong demand zone here. So I don't think it's necessarily the beginning of the end, but it certainly is the end of the beginning, the easy bit, I think, that we've seen up to this point, and we're going to have to work a little bit harder to hold some of these demand points into the future on the S&P 500. Having a look at the NASDAQ, the picture is pretty similar. So we are interacting with this long-term downtrend zone. We're up at, say, 12,986, another key static supply point. Once again, watching for the candles that come in here. White candles, hunky-dory, hooly-dooly, everything's fine. We're probably going to test, hold, do that basing pattern and move higher, as I suggested on the S&P 500. The black candles, they're the ones you need to be worried about, because it will, I think, reinforce this area as a point of dynamic resistance and therefore pull us back down. Again, not the end of the world, simply just the ability to come and test demand, for demand to prove that it's still in the system, say around 12,093, and then use that potentially as a launching pad to move higher and take out some of those supply zones. So, as cautious as I am overall, because I think the macroeconomic picture warrants that, you cannot doubt the strength, at least in the short term, on some of these technical pictures here. Having a look at the commodities, very interesting, because it wasn't a fantastic week for a lot of these commodities. I mean, zinc's up 5%, well, that's great, and lead's up 0.5%, but pretty much everything else went down. So these key industrial metals, aluminium down 2.4%, copper down 0.5% on the London Metals Exchange, but slightly worse there, 1% on the high-grade contract on the COMEX exchange in the US. Iron ore edging lower, both in China and in the US dollar-based Singapore price. So whilst equities continue to be partying, it does feel like with the recent weakness in commodities being reaffirmed last week, that this idea that equities are rallying against this worsening global growth picture and the disconnect between those two. Having said that, let's do a little bit of technical analysis here on the iron ore chart. This trough here, potentially, if it continued to build, it's certainly higher than that 95.5. Maybe there's an inverted head and shoulders. Maybe we're starting to turn the short-term trend around. But I'm really grasping at straws there. Long-term trend's still down. I don't think you want to get too excited about that. Again, copper, is this the start of a fledgling rally? Yeah, potentially. Nice little V-shape there. Test, hold in this short-term downtrend zone, which is starting to get more neutral, starting to contract. There's the potential maybe even to pop up to 85.02 within this longer-term downtrend. So I'm conceding that there could be a little bit more strength in the near term for commodities. How is that going to change this global growth picture? I don't know. I mean, the markets have been helped by this significant fall in commodity prices, and that's helping that inflation picture as well. So you've got once again just so many instances of inputs of informational inputs, which can be construed as positive, both positive and negative at the same time for equities. Gold's another one of them, isn't it? Well, gold rallying, telling you bad times ahead. Look, maybe it's still pretty flat. Overall, it's pretty close to where it started, that chart. The oil price coming off during the week, double-digit declines on West Texas and Brent, and you can see how that has manifested itself on the chart. And to be fair, I've been absolutely spot on calling this one for the last couple of months now, that the short-term trend had changed, and in fact predicting very early that the short-term trend would change so much it would actually impact the long-term trend, and that's exactly what it's done. And you can see in terms of the technicals just how important these long-term trend zones are. And once we sort of get into that zone, if we fail to bounce out of it very quickly, we can often spend a lot of time in there, and that's never a good sign. We tend to break through. So I guess that's why I was kind of predicting this failure here of the long-term trend. We're beneath it now, but there is plenty of support. 83.41, for example, 73.34. It wouldn't surprise me at all to see oil trade in that range. I can't see oil coming off significantly because there are still a number of supply side issues there. But what we're seeing here is this response, I guess, to the possibility that global growth is much slower down the track than was expected not that long ago. Aussie dollar reflecting some of those commodity price moves, the weakness there down about 1%. But to be fair, it was largely also about a resurgent US dollar on some very strong US dollar-based economic data. We'll talk about that in a second. We can see there somewhat reflected in the bond yields, the Aussie yields rising a little bit, but the US bond yields rising a lot. So bonds being sold off. You don't want to be in a fixed interest asset in a rising interest rate environment. So that's why you're selling your bonds. There's an inverse relationship between your bond prices and bond yields, and with bond prices coming down, that's why we're seeing yields going up. We can see a little bit there on the Aussie one. More broadly, the Aussie yield sort of picture is one of weakness over the last couple of months, as I guess markets are factoring in, well, this big ramp up by the Reserve Bank of Australia, another interest rate rise this week, talk about that in a second, is starting to have a negative impact on those longer term growth expectations. Therefore, at some stage, central bank potentially having to cut rates. Not reflected at all in this picture, because what we're looking at here is the US 2-year yields. And I haven't shown you this chart before, but I think it's a really important macro chart. It's one you have to know about, get your head around, because what we're seeing here is the much shorter end of the US yield curve. So it is more tied to the hip to those Federal Reserve interest rate hikes. Okay, increases in the cash rate clearly have to be felt more in the short term than they are in the long term. There's a little bit more flexibility in the long term, because there is the possibility by the time you get to the long term, rates have come down again. Okay, so just note here the shape of that chart. It's still very, very bullish. If it was a stock chart, you'd be buying it. It's not a stock chart, of course. It's the inverse of a bond chart. It's yields potentially going higher in the short term as the Fed continues to grapple with this inflation problem and continues to fight it aggressively with cash rate increases. Now, contrasting that, and what a great little flip there, isn't it, in the charts, because you can see the contrast between those 2s and here we have the 10s. So in the expanse of time, potentially between that 2-year period and that 10-year period, what the market is saying here is that, well, these interest rate increases by the Fed potentially are going to break the economy, and we're going to have such low economic growth that at some stage the Fed will have to cut rates and potentially cut it aggressively. Having said that, this is, you can see here, this is the last 5 candles. So we've got Monday was coming down in line with that short-term trend. That was what I was tipping. But then you had this huge rally on Tuesday in yields, I should say. Rally in yields, fall in bonds. Wednesday, Thursday, and then another bumper day for yields on Friday. So what we're seeing here is expectations that the Fed is going to have to act more aggressively. It's being borne out to a larger magnitude on the 2s than it is in the 10s. We'll talk about the consequences of that in a second, but I'll just give you some of the data that happened on Tuesday. We had some household debt numbers come out for the US. So the US consumers continuing to pile on the debt, particularly in credit cards and short-term personal loans. So 13% increase in credit cards. That was the largest move in more than 20 years. So take note of that. And consumer loans up by about 25 billion. That was the largest rate of increase since 2016. So in many ways, Americans are, obviously facing these higher costs of living, but a lot of it is being paid for by credit now. Now, why is this a problem? Why is increasing credit a problem for the US economy? Well, because interest rates are going up. That's what I've been talking about for the last 5 minutes or so. Now, how does this? How do the 2 and 10s relationship bear out in the yield curve? Because this is very important. You can see here that we are in those sort of 3.2s. For the 2-year yield, 3.24 to be exact. And then as we get out to the 10s, we're coming into that 2.84. So we've got this 40-odd basis point inversion from those 2 to 10s. And inversions in themselves are quite rare in the history of markets. They don't happen very often, but when they do happen, they have almost exclusively pointed to a recession in the not too distant future. Now, we've already had those 2 negative quarters of US GDP. We know about that. Of course, the talking heads out there aren't calling it a recession due to the strength in the labour market, but we shall see. Point is, the inversion got steeper during the week based upon all of the data, and obviously rates heading up as well, so the yield curve shifting up. The other thing which pumped those yields on Tuesday, we had Mary Daly, one of the Fed heads there, stating that the Fed is quote unquote nowhere near almost done in terms of raising interest rates and fighting inflation. And then you had Chuck Evans, another one of those FOMC members, saying for the next meeting, 50 is a reasonable assessment, but 75 could be okay, talking about the potential interest rate increases to 75 basis points. I think that's the market's view now anyway. But the more worrying thing he said for markets was that he viewed rates need to go to a sufficiently high level of 3.75% to 4% potentially by the second quarter of 2023. And that is well above the market expectations. Now, let's have a quick look at what's going on in China. We've heard a lot of talk about how weak the Chinese economy has been. Certainly it has been. We're looking at the Purchasing Managers Index for the manufacturing sector and services sectors. On the left, we've got the Caixin manufacturing survey. So that's a private company that goes out and surveys various Chinese companies around the Chinese geographic region. And then we've got the official numbers coming from the National Bureau of Statistics. Some people prefer to use the unofficial ones than the official ones because sometimes the official ones may or may not be a little bit cooked. They're both saying roughly the same thing here. In fact, if anything, the official ones are worse, showing that we did see a pullback in the rebound as we come out of those COVID lockdowns. The trend, I think, is what you need to look at here. And you've taken out some of the blips. I think the trend was certainly still down before those lockdowns. And whilst we're getting a bit of a bounce back, I think the trend is resuming here. So I'm going to look at that as continuing bearish news for the Chinese economy. The next thing I'll show you today is very interesting. It's showing just how hard it is to pick markets at the moment. Harder to pick than the proverbial broken nose, as they say. And we've got some very different readings on the US employment market here. And remember, the only reason we're not officially in a recession, according to the authorities, is because of this employment market apparently being so strong. But on the left here, the JOLTS job openings, highs and quits survey. So we can see in orange, that's this line up here, the number of openings. Now we got to nearly 12 million openings in the US economy. You can see compared to pre-pandemic, double what we were experiencing pre-pandemic. So extraordinary, unprecedented, all those sorts of things. But you can see over the last few months, it certainly has been coming down and coming down quite sharply. Okay, so that is US employers, US companies responding to some of the uncertainty in that macro picture. We're also seeing a flattening out, substantial flattening out, I'd suggest, in terms of the number of hires. but also the number of quits. The quits is important as well. It's giving you this forward-looking sort of indicator of confidence in that US job market, because you are not going to quit your job if you are worried about your financial situation. Okay, you're going to hold on to that job for dear life to make sure you can pay your bills, your kids' college tuition, and all of those sorts of things. So we can see certainly quits have been rising because people have been able to switch jobs, get better conditions, get better pay. That stuff is starting to back out. And we're also seeing a trend change in the weekly jobless claims. So, just it's gradual, but after a long period of decline, as we came out of the pandemic, we're starting to see those creep back up into sort of the mid to high 200s there. Okay. Now, contrasting that, we got a pretty huge print, albeit a little bit of an outlier, I'd suggest, compared to the last few months. Okay, but nonetheless, 528,000 jobs created in the US economy last month, and that absolutely blew past expectations for just 200,000. So you can see some of the stuff I was talking about before, how that was reflected in expectations, and then we got this crazy huge number. It was obviously well above the previous one as well. Now, there's two parts to this sort of survey out there. We've got this household survey, which off the top of my head, I only think about 170,000 jobs were created, okay, far more in line. And the household survey takes out a lot of the double counting that you get with the establishment survey, which goes to the non-farms and works at the company level, okay. So maybe it wasn't as good as you think. Having said that, doesn't matter what I think, the market we saw through the bond market there responded quite aggressively to this number, where we did see obviously yields spike, bonds come off. So it is something that the market is telling us that the Fed will respond to, I think. Okay, if the Fed responds to it, here's the problem: if the Fed does respond to it and acts more aggressively, my fear is that some of the other weaker readings that could be misjudged, and we get the harder landing than we expect. The participation rate fell. But there are over 500,000 Americans reported that they just couldn't get to a job interview or get out there and find a job because of COVID. So that is labour that is going to hit the market at some stage, and ease some of the tightness in that jobs market. The unemployment rate came down to 3.5%. Okay. Now, bringing it back home, the RBA delivered its interest rate decision for August, its August meeting, up another 0.5%. You can see they're backing up May's lift off, 0.25%, June's 0.5%, July's 0.5%, so 3.5 interest rate hikes in a row. According to RBA Governor Philip Lowe, it's just another step in this normalisation process. Geez, they're overworking that word, aren't they? Normalising monetary conditions. So they were abnormal. We've got to get them back to normal, but everybody's trying to figure out, well, what is normal in the current environment? A couple of interesting additions to the rhetoric here. Acknowledging that some increase in unemployment is expected, okay, as economic growth slows. So here we are in the same sentence, and here we go, take further steps in the process of normalising, obviously reacting to high inflation. So, we've got, in one sentence, we've got rates going up, we've got unemployment rising, and economic growth slowing. And I'd put to you, they are not necessarily Goldilocks conditions for equities. They are the exact opposite of. The average Australian now paying pretty close to $500 more today on the average mortgage compared to where they were in April. That's got to also have an impact on the economy and company profits, and the market is now split between a 25% or 50% basis point hike in September, but still expecting rates to be around about 3%, just over 3% by the end of the year. Aussie shares, we can see, had a pretty good week, just energy missing out. We know the oil price tanked. That hurt them. Property trust don't like it when interest rates go up. They got a little bit hurt there, but otherwise very strong gains. Healthcare up 3%, in information technology up 3.2%, telecoms, let's call them pretty much technology anyway, up about 3%. They fall away from there. Gold had a bit of a bounce as well. Financials lagged because there's the interest rate sensitive there. So financials have had a huge bounce. We can see the Aussie markets bounce here. Now, if you get a chart of the XFJ, I actually don't have one for you today. Apologies, go and find it. It looks almost exactly like this. Okay, so this rally here is very much a financial sector story. 7.3%. So look at the 1 month gains now. Yes, gold, it's volatile, but it's a tiny contributor to the overall index. Information technology, it's got a slightly larger contribution than gold. and it's very volatile, but it's the order of magnitude of contribution is nowhere near the financials. Materials, that's a big contributor to the index, but it's only up 4.4%, okay? And that's actually lagging the 5.5%. I'm going to put to you that the majority of this gain here is sitting in the financials. And the financials have had this huge bump on this liftoff in rates from the Reserve Bank, because what they get to do for a period of time, and they're going to make hay while the sun is shining, let me tell you, is increase our mortgage rates and by a large amount, and increase our term deposit rates by a very small amount. And what that does is just absolutely fatten their net interest margins, their profits, okay? So we've got this medium-term bump where banks are brilliant, and it's helping the index. And my concern is it's juicing the index. The index is higher than probably where it should be, especially if the banks turn around from here. And there's a bunch of reasons why the banks will find it harder, to outperform the index going forward in the future than in the past. And that is because of that big yield curve inversion, okay? Banks like a steeper curve. They don't like that inverted curve because it really erodes those same net interest margins. So we've got a bit of a bump, bit of a period of where they're going to, have their pound of fat. But I do think with a slowing economy, with higher potential provisions for bad debts coming as a result of that slowdown in the property market, bank shares will find it hard to continue to beat, and that could provide a drag on the overall index. Hey, they're all fundamentals. Let's have a look at the technicals. The technicals still look good, vertical, white candles all over the place, high peaks and troughs, but I do have to respect this long-term downtrend zone. We know on the way up how good it is at supporting prices, and we find on the way down it tends to resist, and that's what we're going to be dealing with this week. So watch how we perform around about 7,000. It's a little bit like the US markets where I said watch out for those black candles. They'll tell you, they are the fingerprints of supply, and if you start to see those fingers of supply come in around here, then probably the party is over in the short term. Hey, if we don't see it, we see a bunch of white candles, we've got more to go. 72.89 is a possibility. If we do pull back, 69.30 I think will act as a little bit of demand here, but 67.64 is probably, well, look, actually there's some demand here between sort of 68 and 69. See these white candles? Maybe that's the fallback, but probably in here as actually the short-term uptrend starts to have an impact as well. So pullback scenario, let's call it 68.50-ish, okay? Worst case, 67.50-ish. And that would be where you'd be looking for the next fingerprints, whether they be white candles or black candles. Having a look at the technical analysis, market breadth. Now I'm just mindful of time. I've gone way over, talking too much this week, sorry, but there's so much going on, so many interesting factors at play. The market breadth continues to get better. So we can see this orange line is padding out away from last week's dash yellow line. And as this fills out and fills out and fills out, so we've got more and more companies getting above those respective moving averages down there and closer to this green zone, which is a bull market zone. That's more ammunition to argue that the new bull market has begun. In fact, we've got now 2/3 of companies above their 2-month trends. That's how good things are getting for some of these Aussie stocks. Okay, so this is the bull market zone in here, the green zone. We had a little bit of a pullback in the short term there towards the end of the week, but otherwise it is an improving picture, and it's reflected here as well. Look how many short-term uptrends are. It's unanimous, and look, I actually can't remember the last time it was unanimous, because even on the way up when the market was making new highs, you had sometimes sectors like information technology, which weren't performing so well, or REITs. There was always one sector which was in a little bit of a downtrend, even as the broader market was rising. But to get that unanimous up on the short-term uptrend reflects, again, such improvement there in that market breadth. We still have some issues here in the long term, again, reflecting what we said in market breadth. Financials could flip back to up. I'm not so sure based upon what I said before. Watch that one. Otherwise, energy, it's on the verge of maybe going back to neutral. Probably not allocating any new capital there. Healthcare is the best sector. Hands down, that is my favourite sector right now. I'm still liking a number of names in there. So CSL looks good. Cochlear, rapidly improving. ResMed still looks very good. And a lot of those biotech companies as well. I look at a chart like Polynovo, PNV, Recce Pharmaceuticals, RCE off the top of my head, and Telix Pharmaceuticals, TLX, looking very good. And Terrace technology is looking very good. So I can find a bunch of buys in that sector. Staples, Woolies, Coles, still hands down the best there, but let's face it, they are the entire sector. Looks pretty good. Utilities, APA, doesn't look bad at all in those. But I think avoiding many of those other sectors. Looking at some of the valuation metrics here, we can see that the overall 1 year forward PE, so this is Thomson Reuters estimates for the PE, they take the broker consensus, so 15 odd brokers, what are their expectations for the 1 year forward PE for the market at 13.7. And the old rule of thumb is 10 is about cheap. We didn't quite get there. 12.7 was the lowest point we got to in this last move, and 20 is expensive. So 10 is cheap, 15 is fair value, I should say, and 20 is expensive. So here we are going from cheap, heading back towards that fair value around 15, and you can see how the other sectors have responded there. In the interest of time, I'll let you press pause and have a look at where they are relative to their ranges, okay, and see which ones are on the cheap side, which ones are on the expensive side. The data coming up for this week: Westpac Consumer Sentiment Survey, NAB Business Confidence Survey on Tuesday. Otherwise, very quiet week. Looking abroad, not a lot of data coming up, but some important ones, mainly the Chinese inflation data here, both the consumer level, CPI, and the producer level there, PPI wholesale inflation, and then the same for the USA. So we've got the CPI coming out on Wednesday evening our time, expecting a 0.2% month-on-month increase, well down from the previous, and that's because crude oil prices have come down, and prices at the pump over there in US for gas have come down significantly, and as a result of that, you see the headline actually print lower than the core. The core is the important one, and that is still very, very hot there at 0.5%, because it's a monthly thing, and if you said, well, what's 12 times 0.5, you're still at about 6%, aren't you? Which is way too high as far as the Fed's concerned. And then we've got the wholesale inflation coming out on Thursday, and then the University of Michigan Consumer Sentiment Survey. And these are important now because we have seen significant weakness in many of these surveys, but we're expecting a little bit of a bounce back there on that on Friday. Look, I'll be back tomorrow if you've got any portfolio questions. So today is very much about all of the economics and trying to tie it together for you, help you make good portfolio decisions. But tomorrow I'm going to give you even more support. Tune in at 1 p.m. Tuesdays. We do them every Tuesdays at 1 p.m. And I'll actually have a look at the stocks in your portfolio. So make sure you register. There's the link to do so, and I'll see you then. Apart from that, ThinkMarkets Australia. If you're not with us, you should be with us trading your shares, your CFDs, your FX. Look, we do it all. And that's the great thing about ThinkMarkets, is you can trade all of those wonderful products from the same account. And over 3,100 shares and ETFs. If you're looking to trade shares, $8 flat rate, HIN and CHESS sponsored, very important. 24/7 customer support, world-class trading app, and of course you get my analysis. Head to that link there, www.thinkmarkets.com/au. Register for an account. You could be trading in minutes. If you're watching me on any of the socials, make sure you hit the subscribe button to get notified of any of our future updates. And if you like what I'm doing here, make sure you hit the thumbs up button, and we'll continue to do more of it. Apart from that, it has been a pleasure chatting with you this morning. All the best for your trading. Until we catch up again. Bye-bye for now.